Hi, I'm Luke Tate, here with Dave Young, and we're here to talk about how here at Paragon we offer complimentary portfolio reviews for potential investors who are looking to better their situations. And we want to talk a little bit about some of the main things that we see in these portfolios that are problematic and hindering the gains for each of these investors. So Dave, in your experience when you're doing these portfolio reviews, what are those things that you notice most that are just big red flags?
Well, there's 4 or 5 things that stand out, and it's amazing how often you see them over and over and over. Probably the number one thing that I see that is a mistake in people's portfolios is just that their portfolio is not aligned with their risk tolerance.
So what does that mean, risk tolerance?
That means how much risk a person is comfortable taking. So in other words, each person has some level of risk that they're comfortable with. I mean, maybe they're comfortable with no risk. They don't ever want to see their account go down at all. Maybe they're okay with some fluctuation. Maybe they're okay with a lot of fluctuation in the value of their portfolio. And so each person, we have them fill out or take a questionnaire to identify that risk tolerance. And once we've identified that risk tolerance, then I'll compare their existing portfolio and kind of identify for them how much potential volatility they have in that portfolio. And that's probably one of the most common things I see as far as a problem is someone will say, I've got a low risk tolerance, but then when you look at the holdings in their portfolio, they're very high risk.
So that survey is probably pretty good for people because a lot of times you probably run into people that don't quite understand their risk tolerance.
Yeah, I'd say the majority of investors haven't really thought it through. You know, they just go out and they invest in things that their brokers recommend or advisors recommend, or they just buy on their own. And they just build this portfolio without a really regard to how much risk they're taking. And then they realize how much risk they're taking when they start to go through a really volatile market. And usually at that point, that's the worst possible time to realize that, because as the market's tanking, their portfolio goes down, they get scared and they jump out. And then after that, the market recovers and they've lost a lot of money. So not being aligned with their risk tolerance is a huge issue. Another issue is costs, the cost within their portfolio being a lot higher than they need to be. For example, we use a lot of exchange traded funds that cost a fraction of what mutual funds cost. And so if you can get the same exposure with a lot less cost, we encourage that wherever possible. And so that's another area we see people spending a lot more than they need to. One of the most glaring ways of having too much cost is when people have an annuity within their IRA, because you're already getting the tax protection from the IRA. You don't need to pay more for an annuity within that. But I see that over and over and over. They've been sold an annuity inside their IRA.
So an annuity is designed to give you tax protection, but when you put it in a tax protected account, it kind of nullifies the advantage that you get from the annuity.
Yeah, it makes you pay for it twice. It's kind of like wearing a belt and suspenders at the same time. You know, you don't need to do that. It's going to cost too much.
That makes a lot of sense. Well, what are some of the red flags that people can look at right now inside their accounts or inside their portfolios to see maybe I'm not as well diversified, or maybe I need to make a change?
I've actually seen on the diversification front, that's an issue too, is sometimes people are not diversified enough, and then other times they're way over diversified, which ends up costing them more because they're paying to be more diversified. But as far as red flags, I'd say if, when we've gone through a market sell-off, your account's gone down more than you were comfortable with, that's a red flag. That would be a reason to have a portfolio review. Or if over the last few years your returns haven't met your expectation, that's a reason to have a portfolio review. Those are both pretty basic reasons to have a review.
Okay. Well, some of the things that you look at in the portfolio review to give people as advice in terms of looking forward, do you match up that risk tolerance with their goals?
Right. We look at what their goals are, we look at what their risk tolerance is, and then we build the portfolio based on that to meet those two objectives.
Okay, excellent. Well, just so everyone knows that you're welcome to call Paragon Wealth Management and receive a complimentary portfolio review. And the best number to reach us at is 800-748-4451. Thanks a lot, Dave.
Thanks.